Because when COVID hit, holy crap. Understandably so, though. I must say that. But I kept buying. It pains me to sell stocks, and that's what led me to double up my money. But we're almost a couple hundred off the all-time highs, so get rid of this cat. What a week. Welcome back, guys. My name is Nick. This is my lemonade stand. This is the channel where I do weekly portfolio videos. In these videos, I give my thoughts on my own personal finance, investing in real estate, stocks, crypto, and the like, as it all relates to financial independence and retiring early. I think of investing as a means to improve my lot in life. It's also fun, but that's not what this video is about. All right, so we've got the portfolio pulled up. We're looking at the last month here, and we're up almost $250,000. This is down quite a bit from the high on November 4th. That was about $200,000 ago. Down quite a bit. This has really been as a result of Tesla. For the week, we are up 1.76%, almost $30,000. But all those gains have come today, really. Up 2.5% as of this recording, up $40,000 today. That's all Tesla. Up 3.7%. Kind of bouncing off yesterday's low. We'll see if that trend continues. The rest of the portfolio roughly flat. The biggest thing here, Lime Hedge is down 1%. A lot of this is Wheels Up, down 5%. But I've been buying Wheels Up. I don't know if we're going to get into that on this video. I really want to talk about what's been creating a lot of this turbulence in my portfolio, which is Tesla. We're going to talk about why I'm a buyer, why I'm a holder, why I'm not a seller, and then we're also going to look at other stuff I'm buying. So looking at Tesla here, it's been quite a ride. We're about $200,000 down from the high on November 4th. This, of course, after our massive run up. Just looking back at October 18th, we were under $1 million. So nothing really to write home about. What's going on right now? I think that is the question. Well, Elon is selling stock, millions of shares. In fact, there's even lawsuits here in the news relating to tweets relating to the selling of this stock. As he exercises his options, he has to pay ordinary income tax, which will be billions of dollars. These options are a part of his stock-based compensation plan. So what would you do in this situation? Well, you can only sell shares or borrow against them. Elon has borrowed in the past, but now he's selling. And he announced all this selling the weekend after the peak. So last week was rough. Selling this much puts downward pressure on the stock. If you think that this is a bearish signal, not the downward pressure, that effect is temporary, but the fact that Elon specifically is selling shares in the company. If you find that to be bearish, it is worth pointing out that at the end of all of this, Elon will actually have increased his ownership in Tesla. You can point out that it's dilutive to shareholders, and I just say to that, well, the juice is worth the squeeze, so play ball. So at these levels, what am I doing? I'm buying the dip. Calling a dip is a bit of a stretch, of course. We're now about 15% down from the all-time highs. We got as low as about 20% from all-time highs. Sounds like a dip, of course, but we're still up 2.25% from just October 25th, and we're up 156% for the year. So it's not really a dip, but we're almost a couple hundred off the all-time highs. So get rid of this cat. So I've been buying Tesla, but not hand over fist. I have a 70% allocation in Tesla. I think just holding for me shows an incredible amount of conviction. Having that much allocation to just one stock is a little nosebleedy for most people. So for me, buying more Tesla has been like more of like a precision-based surgical endeavor. About a month before earning calls, we get a preliminary delivery number. If these deliveries support my long-term thesis, and the last several quarters have, I'll usually buy a little bit, particularly if the market isn't really acting on the news. Then I look at the quarterly results and listen in on the earnings call. I want to make sure the fundamentals are supporting my long-term thesis. What's been interesting over the last several quarters is that Tesla is getting cheaper. Not in price, as the price has been going up through the roof, some would say, but in the underlying earnings in which we derive value. The earnings have been growing faster than the share price. After the last 3 quarters, Tesla has been trading at its cheapest levels relative to earnings ever. If you thought Tesla was expensive at $1,000 a share, well, let me tell you, it was really expensive at $30 a share and has actually only gotten cheaper. So after the past several quarters, I have been a buyer, usually like the first day or two, maybe the first 3 days after the quarter, I have been a buyer still of Tesla. I've got to point out though, cheapness isn't really a good way to time these sort of things, but when holding for the long term, these moments serve as nice entry points. When you're holding long term, you're not just considering earnings, fundamentals, and value as it relates to those two things today, but what does the consensus think about Tesla going forward, and how does that mesh with what I think? So I read bearish analyst reports, and a lot of it, frankly, isn't based in reality, which for me is bullish. Because if your argument is that there won't be widespread EV adoption ever, and it's just a niche market, or that the Tesla growth story is broken, well then any money that's taking your advice will eventually get a rude objective dose of reality. I see that and I look at it as just future money off the table that will head my way. But what's interesting is when I read bullish analysts, which on average are based more in reality. They may still have one foot in fantasy land, but that's not what gets me up in the morning. Almost all the bulls are very short-sighted. Tesla is at about 1 million vehicle per year run rate and maybe about 1.2 million at some point in Q4. Maybe 2 of these bullish analysts predicted this a year out, but none of them did it 2 years out. Looking at what the predictions for the vehicle production 5 years out, I look at those numbers and I think we might get there in about half the time. That right there is the basis for why I keep adding to my position. And we're not even talking about robo-taxis, Tesla bots, insurance, or energy, which for me are all out of the money call options that we're getting for free. So there's that, right? I go through the rest of my portfolio and I'm not completely confident that there's any better opportunity elsewhere in the portfolio. I do think my 70% allocation reflects where my headspace is at in terms of this confidence. New dollars that I'm putting to work are more about diversifying my strategy and less about padding my Tesla stockpile. Tesla for me is a never sell stock, and that's why it's grown to the size that it has. All right, Tesla rant over. What else is going on with this portfolio? Well, I've been burning through my cash position a little faster than I like. So for the moment, I'm taking a little break from buying stocks with my cash pals, which is mostly tied up in stablecoins, earning interest at a current rate of 9%. Link below if you want some of that action. Right now, just under $16,000 in straight cash, in cash. The interest, dividends, and rental income are still going back into the portfolio. That part has not changed. So the current cash position, not stablecoin, but cash is just under $16,000. You can see here, these are all transfers out of the cash account. Some of that goes to my Robinhood account. Most of it is going to cryptocurrency, but a lot of it was going to my invest account where I was buying stocks with it. I'm shifting from using this cash pile to just relying on the interest, dividends, and rental income that I'm still completely putting back into the portfolio. That part has not changed. However, something has changed. Let's go look at activity. So this week alone, I've done some large for me selling, which is something I do my best to avoid. It pains me to sell stocks. In this case, I sold mostly to stop the bleeding of my dwindling cash pile. Here on the right, these are my sells. So we have Omega Healthcare, Simon Property Group, Principal Financial Group, Orion Office REIT, and Target. Orion Office is not something I actually own, or Realty Income acquired them or merged with them. So I received Orion Office shares from this merger, and I guess M1 doesn't hold them. So M1 is actually selling those shares. It's not me, which I don't care. I don't really want them anyways. But this other stuff, so I'm gonna get into why I'm selling this other stuff. We'll start with Target. All right, so let's pull up Target first. This has been a great small holding for me. You can see my average share price is under $58. So $58, my average share price. You can see I've had a 366% total return. That does not count reinvested dividends, but it's been an epic run. The earnings growth rate has been spectacular, and the shares have certainly reflected that. Let me take some time off the chart. So a part of this sale is just because it's really Tesla. Target, even with this massive earnings growth, we're looking a little expensive here. We're currently selling at a sub 22 PE. The normal PE for this time period is under 16, and I still like the company, but the stock just looks expensive right now. If analysts are correct and we don't get any growth next year, and the stock returns to its normal PE, we could lose 21% off the top. Part of this is just me getting ahead of that. This was a small position, so it's not that much money anyways. PFG, Principal Financial Group, X out of here. Principal Financial Group. All right, you can see my average share price for PFG is just under $54. Opening up Fast Grasp, putting a marker at around $54 as close as I can get it. I think most of my buying was back then. You can see I've had a good return here also. PFG is a life and health insurance company, which isn't the type of business I really want to own. I thought this was undervalued at the time I bought it. And after an incredible run here coming out of COVID, it's now probably closer to fair value. Let me cut some time off the chart. Yeah, it's looking up about fair value. Unlike Target, which looked expensive to me, holding this stock could be fruitful from here still, which is why I didn't completely sell out of it. Though if this run up continues and it looks a little expensive, I will keep selling this stock. So SBG and Omega Health are both REITs, real estate investment trust. They pay a lot out in dividends. However, those dividends get taxed at regular income because they're REITs. So part of my decision to sell these is on that basis, to be honest. You can see here with Simon Property Groups, my average share price is over 86 bucks. Let me change this to operating cash flow. All right, so $86 puts me right there. So effectively, I've doubled my money on Simon Property Group. SPG, if you don't know, owns higher end malls. It's well managed. I started to buy this beaten up company a little too early, back in the 170 to 150 range. So I initially started buying SPG shares after this steep decline here. It looked cheap to me then. I was a little early because when COVID hit, holy crap, the shares dropped an additional 70%. Totally obliterated during COVID. Understandably so, though. I must say that. But I kept buying, lowering my cost basis, effectively cutting my cost basis in half, and that's what led me to double up my money. So I got a decent return. Let's cut some time off the chart here. I don't think it's expensive, not the way Target is, and this company is totally in my wheelhouse also, unlike Principal Financial Group. I think in a few years, I might have a really great yield on cost. Right now, it's about 8%. I think this company should continue to raise that dividend. But for me, the position size is just a little too much for my confidence level. Now let's look at OHI. I've sold a lot of this, really cut my position by about 66%. So it's going to be way down this list. Where are you? There it is. All right. So average share price for Omega Healthcare is 25 bucks. Not too bad. Omega Healthcare has had a really rough go of it through COVID. My cost basis is right around $25. So I really ticked this bottom. I bought most of the shares back here. So my return, my total annualized return has been nearly 12%. Even after, you look at the stock price here and it does not look pretty, but I've done okay. Getting that bottom has provided me with a lot of dividend income, which is nice. As I mentioned earlier, the dividend income for these companies are not taxed at long-term capital gains rates, but they're taxed at ordinary income. I bought these shares back here because I believed the very high dividend yield I was getting was safe. I'm not as confident about that anymore. However, I don't think it's a big risk that they're going to cut the dividend, but it certainly is on the table. This was never going to be a stock that moved the needle for me anyways. So I'm figuring why continue to pay the ordinary income taxes on it. Also, selling here doesn't produce significant capital gains like with the other stocks because the share price has not really gone up that much. All right, so I'm going to leave you guys with that. Those are the things I like to consider when I'm making these types of moves. If you're into this sort of thing, hit the like button. button, subscribe, check out my other videos, and tell me what you think about all this in the comments. Now, get the hell out of here.